Good day. Today is lecture number 45 of this very extensive and very interesting subject of investment analysis and portfolio management. Today we will be talking about all that was discussed in the previous 44 lectures. We shall today look at what we've looked at from the beginning. And the first thing we looked at was what actually is investment. Why do people invest? So we talked about investing being something that you could consume or save or invest. And the reason why people invested was because they needed to supplement their incomes by way of dividends and interest, and also for improving their wealth through capital gains. So these are some of the reasons people want to invest, people want to save. They want to enhance their cumulative wealth. They want to supplement their incomes through regular dividends and regular interest coming their way. We talked about ways people can invest and how they can put their monies to good use. We looked at the investment alternatives available, and we looked at the fact that people could invest in assets, and assets are things that people own. So you could invest in financial assets, or you could invest in real assets. If we were to look at financial assets, we would be looking at buying stocks or bonds or futures, or we could be talking about real assets like land or commodities. In the subcontinent, people prefer to squirrel away their savings into commodities such as land or gold. So you could invest in financial assets or real assets, but focusing on financial assets, we would look at assets and the alternatives available in the financial sector. So we would look at three broad categories of alternatives available to an investor. And we would talk about investing in variable incomes or equity investments, which have the stock market as the leading alternative, the common stock. We could go in for fixed income investments, which would mean preferred stocks and bonds with fixed incomes to be generated, and then we could talk about derivatives. And in derivatives, we could talk about futures and options and forwards. If we were to talk about stocks, we could talk about different types of common stocks, like categories in blue chip stocks or income stocks or cyclical stocks or defensive stocks, which would help give a variation to your investment horizons, with blue chip stock being the best of the best, giving you unparalleled returns of capital gain and a regular inflow of dividends coming your way through an uninterrupted history of the past 10, 20, 30 years, and you would feel comfortable investing in blue chip stocks. Or you could go for growth stocks, or maybe speculative stocks, or for the bottom of the ladder stocks like penny stocks would be more like very risky junk bond stocks, which could give you phenomenal returns, could also create a disaster. So you have variations of common stock categories in which to invest. It is for you to choose what sort of stocks you want to get into. So, blue chip would be the best, penny stock would be the most unlikely of investments, but you have all sorts of investors because you could be speculative by nature, you could be conservative by nature, you would maybe want more risk and more gains. But to do all this, you've got to get involved into the stock market, which is the secondary market, And then obviously you have to have a certain sort of mechanism, types of orders that you have to place with the broker through which you do your investments. Then the most common ones would be the market orders, in which you tell the broker or the trader that you would want to get the best possible rate prevailing in the market. You could also suggest that you would want a limit order placed on your orders, which would mean specifying a price limit at which you want to buy or sell your stock. You could also use stop orders to minimize losses and maximize profits, and you use it to avoid unnecessary losses. Unfortunately, not many people do that. If you were to be trading in the stock market, then you would have to set up an account, a different type of account for a different type of an investor. So you may have a cash account or a margin account or maybe any other type of account as well. If it were a cash account, it would mean that you'd put up with all the cash so that you can take deliveries of shares. If it's a margin account, maybe you're planning to trade, and then you would talk about using leverage to expand your finances, extend your finances. Or maybe you want to play it safe and just invest your money not in the common stocks, but in the continuous financing system in which you'd get a fixed income as well. To do all this, you need to do certain analysis to decide what sorts of investments you need to do. We do two types of analysis: fundamental analysis and technical analysis. In fundamental analysis, we understand it has a very broad scope and talks about qualitative factors and quantitative factors. They look at financial statements, and you could use fundamental analysis in conjunction with the technical analysis. So in fundamental analysis, you would be looking at financial statements of a company that you would be planning to invest in. You could look at the tangible and measurable factors, or you could look at the general outlook of the company or the industry. We talked about the EIC analysis, which would mean the macro analysis and the micro analysis, which would mean analyzing the economy, analyzing the industry, and then analyzing the company. So you would then look at analyzing at the macro level and then focusing on the stock that you're interested in. And then you could look at the performance of the stock in relation with other companies in that sector and see if it's a good stock, whether it's an underperforming stock or above average performing stock. So you look at sector sentiments, you look at the consistency of improvement in your industry of choice or the erratic behavior of the industry. You would look at the sector in general. But if you were to be looking at the stock, then you would be looking at the balance sheet, which highlights the financial condition of a company at any single given point of time. The balance sheet will give you a snapshot of that particular period. It will list all the assets and liabilities of the company. And it will also let you look into the assets or maybe look at the retained earnings and maybe also look at what sort of stocks are being issued by the company. So you'd look at a snapshot in general. You'll also be able to look at different assets and liabilities and weigh out whether you have a positive balance sheet or a negative balance sheet. You can also have a look at the income statement. You'd be looking at what sort of revenues are coming in and what sort of expenses or what sort of monies are being spent in getting towards the income. And the difference between the two. The difference between the two would be a profit or a loss. So if you're looking at a profit or a loss, you'd be understanding the income statement, which would also be including such good things as the revenues, the net incomes, and most paramount, the earnings per share, which will help you know the company much better, being financially stable and being able to grow. And then when the company grows, your investments will grow with it. So we could look at the balance sheet, we could look at the income statement, or we could look at the statements of cash flows, which I believe are similar to the income statements, but they also look at other incomes like near cash, or they could be looking at depreciation as well. So cash flows give you a better picture because you've also looked at the enhancements of the companies and also the depreciation aspect of products in the company itself. So the cash flow statement strips away all kinds of ambiguities and tells you all the facts that you need to know. It'll tell you what sort of cash is being generated by the company. The cash flow statement will tell you how much revenue is being generated by the company, how it's performing, and will give you a relationship between inflows and outflows of the company. While talking about fundamental analysis, we could look at multiple ratios. We could be looking at profitability ratios, liquidity ratios, leverage ratios, investment ratios, and so many other headings in this fundamental analysis. And then we could look at the price to book value ratio, or the current ratio, or the quick ratio, earning per shares, dividend per shares, dividend yield, price earning ratios. These will all tell you different things about a company, and then you can compare these ratios with the average ratios of the industry and find out for yourself whether the investments that you're going to be making are going to be sensible or not. We mentioned that in conjunction with fundamental analysis, we could also use another type of analysis more commonly known as technical analysis. So where fundamental analysis is based on prices according to fundamental economic data, technical analysis is all about supply and demand. And this is important for us to understand. One is about the economic part, the other is about the price movements of the shares. You can use them separately, you can use them in conjunction and supplementing each other and take better advantage of both these fields of studies. Alone, they can be of use. Put together, I think they'll be much better in utilizing it as something of value. If we were to talk about technical analysis, then actually we'd be talking about charts. So technical analysis is all about charts, and charts is all about prices included in the charts. We would look at charts which will show you supply and demand, which will also tell you about investor behavior, and we'd look at different types of charts, the most popular charts being the commonly used line chart, the frequently used bar chart, the infrequently used point and figure chart, and the extremely popular charting methodology taking up now in vogue is candlestick charting. So we can look at all different types of charting, but these for now would suffice to be understood as more popular forms of charting. And in these chartings, we could use technical tools for advantage. Regardless of the types of charts we are using, we could use technical tools like trend lines, moving averages, price patterns, indicators, cycles. It's an infinite number of technical tools available these days for anyone to choose the best suited and use it for making a better educated, result-oriented decision while using technical analysis in deciding what sort of stock to invest into. There are other complex tools like Gann analysis or Elliott wave theories or Fibonacci numbers, retracements, or maybe CAGI, but I think trend lines, moving averages would be very simple and good to use. If we were not to be talking about stock markets, indirect investments, we could look at other indirect forms of investments, maybe look at investment companies. Somebody who could handle your investments in a more professional way if you do not have the time to analyze stocks. So you could go in for different types of funds or assets being managed by professionals, and I am right now referring to mutual funds, which would then also include the closed-ended mutual funds and open-ended mutual funds. The open-ended mutual funds becoming hugely popular and taking over as the benchmark for funds instead of the more traditional conservative closed-ended funds. So we could use these funds as an indirect form of investment for our returns, and we could use strategies then to see how we perform in a passive stock strategy or an active stock strategy, which would mean that in passive stock strategy, we'd be talking about buying and holding on to these stocks for a long period of time. In the actively trading strategy, we would assume that investors know their business, know their studies, have done their technical and fundamental analysis, and would be willing to bear the cost of buying and selling shares more frequently. There are less costs involved in passive strategies. You're less bothered with all the volatilities of the market, but in active strategies you have to be wary of all the pitfalls of active trading and all the volatilities and spikes associated to such an activity. If we were to talk about the market as a whole, we'd be at a loss if we do not discuss the efficient market hypothesis, because it is important for us to understand whether markets are efficient or not, and that the prices of all securities quickly and fully reflect all available information. And we'd be talking about different forms of efficient markets, generally three, basically one being the weak form, the semi-strong form, and the strong form. The weak form would mean everybody having market level data in generic, or the semi-strong form where you would have information on industry, or you'd have a strong form market information specific to the company. To be able to find out how the market is doing, we need to look at some sort of benchmark with which to evaluate, and I would be talking about indices or one particular index of any exchange. All indices are based on different variables, so you could have an index based on the stocks, you could have a bond market index or a future market index, or maybe the number can be infinite as far as indices are concerned. But you could make indices based on large capitalization stocks or judge it with a small capitalizations, but you cannot mix the two together. If you were to be looking at a benchmark for a stock, you have to look at a stock index, not compare it with a bond index. Investments in non-marketable financial assets. And in non-marketable financial assets, which are commonly owned by individuals, we could look at direct exchange of claims between an issuer and an investor. Maybe over the counter, very illiquid, but are still being able to be converted to cash without loss of value. So, we could look at savings accounts as an example. We could also be looking at bonds, certificates of deposits, certificates of investments, term finance securities, and the likes. These are all in line with the non-marketable financial assets, including money market deposit accounts. So you could be looking at money market securities as being marketable. The claims are negotiable or saleable in the marketplace. These are short-term, liquid, relatively low-risk debt instruments issued by governments or private entities, corporations. An example would be maybe a money market mutual fund Another example would be a treasury bill, more commonly known as a T-bill, commercial papers. These then would be parts of the money market security, which is generally considered to be safer as compared to the stock market, which of course by now we know is much riskier than investing in the money market. Money market being for the short term, the stock market being for the long term. So in fixed incomes, we could also be looking at bonds as a way of investments, and then we look at bond prices being inversely related to bond yields. Obviously, we're willing to pay a price on the capacity of something being able to give us something in return. So price volatility of a longer maturity security is larger than shorter maturity security, and holding coupon rates constant. Remember, we have zero coupon bonds which are sold at a discount, and you get up the face value at the time of maturity, or you can have bonds with coupon rates and then you're paid by the amounts already announced, because on bonds you have a predetermined announcement done what sort of returns you would be getting. But to get into a really good bond, I would suggest you look at the ratings of bonds, and these ratings are investment grade securities then, rated AAAs, AAs, A, or maybe a BBB, but that's it. If you were to follow this principle, you'd get into a good investment grade bond portfolio. But if you were to be looking at speculative bonds, then I'd recommend then the BB or a CCC or single B or a single B, but this is all about risk. There are significant uncertainties associated with these speculative securities. So, if you were to look around, you'd find good quality bonds and maybe speculative bonds. I recommend you stick around to the AAA and the BBB bonds. But then, of course, we cannot avoid investments with an element of risk. There is risk in investment. Whether it is investing, whether it's driving or just walking down the street, everyone is exposed to risk. Risk is the chance that an investment actual return may not be what you had deemed will be coming to you. These include the possibility of losing maybe some of your principal investment or your original investments. So when you're investing in stocks, bonds, or any other investment instrument, there is a lot more risk than you'd actually be thinking about. And there are different types of risks involved. Risk, remember, is unavoidable. But having said that, I must add that risk is manageable. There are generally two different kinds of risks involved, one being the systematic risk, the other being the non-systematic risk, with the systematic risk being a general risk and the non-systematic risk being a specific risk. So a general risk is generally where influences a large number of assets, any kinds of assets. Maybe political events would be a good example about that. But if you're looking at specific risk, we're talking about referred to a risk that's affecting small number of assets. Maybe an industry, maybe your particular stock. An example would be news affecting a specific stock would be maybe a strike by the employees of a particular company, or maybe some sort of a disaster in the company itself. So we need to look at different sources of risks. Risk that could be called interest risk, or maybe market risk, or inflation risk, or business risk, or financial risk, liquidity risk, exchange rate risk, or maybe country risk or sovereign risk. The number of sources can be insignificant, or maybe all these sources can combine and give you a headache. But more importantly, we should be looking at inflation and interest rate and political risk and country risk. But for foreign investors, they'd be more excited about the sovereign risk. They'd be more excited about the political risk. They'd be more interested in inflation and exchange rate risk, because you're bringing in foreign currency into the country. So risk can be of different natures or different levels for different people. Now, if you were to talk about risk, we would also talk about diversifying. In diversify, then we would be talking about portfolios, and then we could be talking about portfolio theories, which means optimal diversification taking into account all available information, and then the assumptions in portfolio theories. A single investment period has to be determined, liquid positions, no transaction costs, preferences based only on portfolios, expected return and risk. So portfolio or diversification then would be the best way to avoid risk, or best way to manage risk, or best way to minimize risk. Then we would be talking about diversification. And once we talk about diversification, the name that comes up on top of the list is Markowitz diversification. It's a non-random diversification with active measurement and management of portfolio risk. Investigates relationships between portfolio securities before making an investment decision. Think before you leap. Don't cry over spilt milk. Markowitz decision, Markowitz portfolio theory would be a best guide for anybody talking about diversification. It takes advantage of expected returns and risk for individual securities and how securities returns move together. So if we were to be looking at diversification, if we were looking at portfolios, it would be a good idea to look at Markowitz portfolio theory. Then we could look at an efficient portfolio, which would mean the smallest portfolio risk for a given level of expected return. We could also look at the largest expected return for a given level of portfolio risk. From the set of all possible portfolios, we only locate and analyze the subset known as the efficient set, the lowest risk for given level of return. So having an efficient portfolio, managing the assets, but before managing the assets, deciding what assets have to be put into the portfolio would be a good idea. To do that, we'd look at the theory of portfolios and decide what are going to be the best ingredients for the portfolio. So all of the portfolios in attainable sets are dominated by efficient sets. Global minimum variance portfolio is the thing, and then smallest risk of the efficient set of portfolios. The efficient set then would be a part of the efficient frontier with greater risk than the global minimum variance portfolio. You must have an efficient portfolio to be able to get an optimal return on investments, a likable returns on investments, which are preferred by way of diversifying your assets and getting best possible returns. So portfolio management, portfolio choice, constructing a portfolio will help us do all that. One thing we must not forget is the capital asset pricing model we talked about, which focuses on the equilibrium relationship between risk and expected return on risky assets. The CAPM is built on Markowitz portfolio theory. They're complementing each other, so CAPM model is built up on the portfolio theory. Each investor is assumed to diversify his or her portfolio according to the model made by Markowitz. So capital asset pricing model is another way of improving the ability of an individual investor or an institution to utilize the resources available in the best possible diversified way by managing risk. So you can have a portfolio choice. The more conservative the investor, the more is placed in risk-free assets and risk-free lending and borrowing. The more aggressive the investor, the less is placed in risk-free lending and the more borrowing. So you are risky, you're doing more risk planning, you can maybe do a lot more borrowing then. But if you're conservative, you'll do less borrowing, do more with lending. So most aggressive investors would use leverage to invest in the portfolio theory. It's all about being risk averse or having the ability to take risk. Obviously, returns are going to be associated with the risk factor. But there is one certain element: you don't necessarily have to get exposed to unnecessary risk as well. If you're looking at a good market portfolio, most important implication of the capital asset pricing model, all investors hold the same optimal portfolio of risky assets. The optimal portfolio is the highest point of tangency between risk-free and the efficient frontier. All risky assets is the optimal risky portfolio called the market portfolio, because the market portfolio itself is all about risk, because there's so many number of companies in a market, there's so much happening in the market, there's so much risk involved in the market, we'd be able to then match our portfolio with the market portfolio, and then we could then look at general average returns on market portfolios, then extraordinary returns made up on the basis of a good choice done by your technical and fundamental analysis. One of the ways you could help yourself is looking at betas, or how accurate are beta estimates. You must keep in mind that beta values change with a company's situation. You also must understand it's not stationary over time. It keeps changing. Estimating a future beta is important. It may differ from the historical beta that you've been talking about. The betas are variable, approximated with the stock market index or approximate return on all common stock. To be able to understand betas, to be able to use betas, you must have an average as well. But let's not talk about one thing in detail and forget about the arbitrage pricing theory. So if we were to talk about the arbitrage pricing theory, we must understand it's based on the law of one price. The arbitrage pricing theory, unlike capital asset pricing model, the arbitrage pricing theory does not assume. The capital asset pricing model assumes two otherwise identical assets cannot sell at different prices. Equilibrium prices adjust to eliminate all arbitrage opportunities available in different exchanges. Since arbitrage is all about taking advantage of the discrepancy in the prices of two exchanges, the arbitrage theory would then mean equilibrium prices. This is all helping us manage portfolios. Portfolio management involves decisions that must be made by every investor, whether an active or a passive investment approach is followed. Relationship between various investment alternatives must be considered if an investor is to hold an optimal portfolio. Portfolio management would be good if we made a good choice of assets in a portfolio, because then it doesn't matter if you're talking about an active strategy or a passive strategy, or using the portfolio as a safe haven or diversified product. But if you're managing a portfolio well, we'll be able to get the best returns on these diversified products. Because when we talked about managing portfolios, we understood that we'll be doing well. To do that, we have to do a performance measurement or an evaluation of what we've been doing. It allows measurement of the success of the portfolio manager. It also allows for the success of the portfolio being managed. The key parts of monitoring strategy and evaluating risk, which are important for those who employ a manager or those who invest personal funds. We have to find reasons for success. We have to find reasons for failure of a portfolio managed fund, or reasons for success and failure of the person who's managing the portfolio. Because the asset manager or the portfolio manager is also responsible for looking after the funds of people, it's important for us to understand it in this context. We talked about equity investments. We talked about fixed income investments. Let's talk about derivatives, the newest kid on the block. What are derivatives? Are instruments whose value is dependent on an underlying asset or another basic asset. Their value is derived from them. Itself, derivatives might not be safe or risky. Perhaps they must be neutral, but we have to look at the underlying asset on which the derivative is being based. So, derivatives would then be another form of alternative investments now available for investors to look at if you need to make a choice between a fixed income or an equity income or a derivative income product. There are a number of instruments in the derivatives market, things like futures and forwards and options and swaps. But futures is an agreement to sell or buy in the future, just like a forwards contract. They are traded on exchanges. A forward contract would be an agreement to buy or sell an asset at a certain future time for a certain price, but are traded over the counter. So, a forward is traded on the OTC market, a future is traded on the exchange, which makes a lot of difference. The exchange-traded product being safer, the over-the-counter product being much more riskier to handle because of settlement issues if they come up. Options is another part of the derivatives market, and an options contract gives the owner of the contract a right to buy or sell in the future. A right, not an obligation, unlike the futures contract. Options are traded both on the exchange and over the counter. Swap is another form of derivative market. It's an agreement to exchange cash flows at specified future times according to certain specified rules. So the buzzword is derivatives, and futures, options, forwards and swaps would then be talked about in more detail in future than compared to the bond markets and the equity markets. But we must understand this new development in the financial world. We must understand the futures market. We must understand that it's different than the spot or the cash market or the regular market, in which prices refer to the items available for immediate delivery, or a forward market where prices refer to items available for delayed delivery, or the futures market, which sets features like contract size, delivery dates, quantities, conditions for delivery. You must understand the varying differences between a spot market or a forwards market or a futures market to be able to use the futures market to your advantage. Otherwise, a derivatives market would then be a dread word. So futures markets would have their characteristics, have a centralized marketplace because they're traded on the exchange and allow investors to trade with each other. And the clearinghouse then gives sort of a guarantee to settle all deliverables on money matters. Performance is guaranteed by a clearinghouse. There are valuable economic functions for different types of investors, like hedgers shift price risk to another kind of investor, which is a speculator. This price discovery then conveys valuable information from one source to another source. So hedgers would then be shifting the risk to speculators who are willing to take it at any cost because they think by taking a risk, they'll be able to gain more. Now, these are the players in the futures market. We also have the commodities market, includes agricultural, metal and energy-related products. We here also have a commodity market right now trading in gold. There are also financials in the futures market, for example, foreign currencies as well as debt and equity instruments. The foreign future markets are all very competitive these days and have their own products available to them and available for investors to use, and these markets are quite competitive with the US markets. It's a growing phenomena, it's a growing field, it's a growing new horizon towards financial assets. It's $1 trillion market, much bigger, and there are people involved in it, people who speculate, people who arbitrage, and people who hedge. The hedgers, speculators, and arbitragers are all participants of the derivatives world. Hedging being the best form of using two different markets, the regular spot or cash market and the futures market, by shifting the risk from one market to another market by having an underlying asset and selling it in the futures market. Or you could do arbitrage by taking advantage of price differences between two different exchanges of the same product. Or you could speculate. You could think about the market going your way without any justification, or also without any support available to you, or also without any underlying asset to support you. So, these players use the derivatives market in a different way. Maybe you could use the derivatives market to hedge risks. You could use it to speculate by taking a view on the future direction of the market. Or you could lock in an arbitrage profit between two exchanges. So you change the nature of liability from one market to another market. To change the nature of an investment without incurring the costs of selling one portfolio or buying another portfolio is a good way of using the derivatives market by avoiding unnecessary costs because of buying and selling involved in the futures market. So, this is a good way of doing investments. It's all about being able to use the derivatives market to your advantage in any numbers of ways. The hedgers use it in their own way by shifting and using as a form of insurance. They're willing to forego a certain amount of profit in order to reduce risk. One of the best ways that you could use the futures market is through hedging. Hedge return is much smaller or low compared to speculative return that is guaranteed to be safe. So hedgers are at risk in a spot market asset, will shift it to the futures market to cover up and to minimize the chances of loss. You are shifting risk from one market to another market. You buy or sell futures to offset that risk in the regular market. And hedging is done at all forms of businesses, at all forms of levels. But speculation is definitely disastrous, is potentially dangerous, because speculators believe that the potential return outweighs risk, which I don't think is quite correct. But the primary purposes of derivatives market is not speculation. Rather, they permit the transfer of risk between market participants as they desire. So, speculation may be very risky, but speculation may also be very dangerous because of the volatilities, because of the uncertainties in the market. But speculators will there be available to help you out with your hedging, your arbitrage, because without a speculative market, you might not have that sort of a dip. But hedgers, arbitragers, and speculators all make this market more liquid. So arbitragers are people who take two opposite positions on the same product or same instrument in two different exchanges to earn a profit. Please keep in mind that derivatives are excessively used for all these three purposes. It's not just arbitrage, it's not just hedging, it's not just speculation, it's used for all these three kinds of trading activities. So, arbitrage would then be locking in a riskless profit by taking advantage of price variations between two exchanges in the same currency Or you could use two different currencies, maybe buying in dollars, selling in London Stock Exchange in pounds, but you could do it as many ways available to you. So, good way of using derivatives is risk management, transferring risk, and also financial leverage. So derivatives may provide financial leverage. You can also shift the equity manager's market risk or the bond manager's interest rate risk, or equivalent to the reason why we had the derivatives was the farmer's price risk, and shift it or manage it from one exchange to another exchange, from one market to another market. So derivatives provides a means for risk to be transferred from one person to another person, from a hedger to a speculator, or from one market to another market. You could also use these derivatives for income generation. Some people use derivatives as a good means of generating additional income from their investment portfolios. So, you could be having your portfolios, you could be having your ability to generate income. And how do you do that? You do that by writing calls. You could be doing that by being a writer. So you could write a covered call, you could write a covered option. You have buyers on one side and writers on another side, and then when you're buying an option, if you're buying a futures contract, maybe you'll have to pay up something up front called a premium, which would mean giving some sort of extra money into the options market. You could also be talking about financial engineering as such, and then you could look at the financial engineering aspect, referring to the practice of using the derivatives as building blocks in the creation of some specialized product. So these are the ways that you could use the products included in the derivatives market. Options is another way that you could use the market, and options are products that you have the facility or the right but not the obligation to fulfill. So you could use an option, sell it to another person, let it go waste, or exercise it. Students, we have covered an immense field, an immense variety of topics covered in this subject of investment analysis and portfolio management. But you've heard me, you've seen me, you've read the books, but the important thing is that you need to apply your mind to all that's been talked about. There is difference for you to be able to understand what's written in the books and actually look at what's actually happening in the world. You need to work hard to understand the realities of life. You need to understand what actually is happening. Of course, it's good to know about portfolio theories, capital asset pricing models, Markowitz. Everything is the base. It's just good enough to make you understand what investments is all about. But to get to the top of the pyramid, you need to have some experience and watch and look and experiment what's happening in the stock exchanges here in our country and see what the investment environment is. You should look towards newspapers, you should go to the libraries, look at magazines, look at books, look at what's actually happening. It's not just the books. Books will give you an insight to the beginning of everything associated to the Western world, but we need to use this knowledge to be applied to the local climate. To do that, you shall need to excessively access libraries, access stock market, access the commodity exchange, look at the different agencies, organization, corporation, look at around the balance sheets, have a look at annual reports, look at what's in the news, watch television. read newspapers, visit the stock exchanges, and then only you will be able to apply all that you've read in reality. Because reality is definitely very different from what you actually reading in the books. So read and apply. Read and practice. And then you'll get to understand the things related to investment analysis and portfolio management. Thank you very much. Have a good day.